Hi, Mrs. Archer.
Good morning, Keith. Good morning, everyone.
Good morning, everyone.
Good morning.
We will begin in a few minutes. Wait for people to arrive.
Good morning, everyone.
Good morning, everyone. Okay, it's 10:07. I think we should begin. So welcome. Glad to see everyone. Glad to see there's some new faces. So this is our second session on our educational program. So we're going to have 6 sessions. This is our second. This will go from 10 to 11, and then from 11 to 12 becomes that is our investing meeting. And so those are for our graduates who want to continue on with the program. And so you're all welcome to stay and see what that meeting is like. All right, so let me get going here.
Good morning.
Good morning. Okay. Again, this program is in conjunction partnership with the Sean Carter Foundation. The Sean Carter Foundation has been supporting this program for over 5 years now, and we certainly appreciate their support. Okay, so we talked last week about the wealth gap, why we have the wealth gap. One reason we have the wealth gap is because low wealth households are not investing in the market. So now we want to talk about the details of how to invest in the market and get that higher return. Okay. And when we invest in the market, most people invest in the market by buying individual companies. And if you talk to your friends who are in the market, that's how they're probably in the market. But we don't want to do that. And hopefully I'll convince you why. But what we want to do is we want to buy collections of companies. So when we invest in the market, we're not buying individual companies, we're going to buy collections of them. Okay. And why would we do this? Mainly for the risk. We're going to lower our risk immensely. So again, keep in mind sort of mantra is we're buying collections of companies, not individual companies. Collections. Okay. Now, there's various ways you can buy these collections. The sort of old technology is called a mutual fund. And in a mutual fund, investors are pooling their money together, and they're buying this collection of companies, right? So if you want to invest in mutual fund X, let's say, you would go to mutual fund X and you would look to see what companies are in that mutual fund. And then you can decide, oh yeah, these are the companies I want to invest in. I'll invest in X. Or you'll go and you'll find some other some other collection to invest in. So keep in mind, there's tens of thousands of these collections, and they already exist. First, let's talk about mutual funds. So again, mutual funds are where individuals pool their money together and they're buying collections. A couple of things about mutual funds. We can take all mutual funds and we can say that they're either actively managed or they're passively managed. Actively managed means that there's some fund manager who's sitting there and he or she is deciding what companies go into that fund. So they're choosing the companies that go into the fund. Now, in theory, they have more knowledge than you, so they should be choosing the companies which will perform well. So we'll see that the fees on actively managed funds are relatively high because you have to pay these fund managers to choose stocks for you. The other type of mutual fund is called an index fund or a passively managed fund. And in index funds or passively managed funds, no fund manager decides what stocks go into that fund. We're just going to replicate one of the stock indexes. So if you remember last week, we talked about financial service companies came up with these stock indexes like the Dow Jones average, the S&P 500 index, the NASDAQ index. And they originally did this to sort of determine how well is the market doing, which is what we talked about last week. But then back in, roughly the early 70s, they started taking these indexes and say, well, let's just make a mutual fund of the index. And this is why they're called passively managed funds, because no one chooses what stocks go into that fund. We just take all the stocks in the index and put them into the fund. So if you invest in an S&P 500 index fund, you have the 500 companies of the S&P 500 index. And you could go to like Schwab, who's a brokerage, or you could go to Vanguard, who's a brokerage, and they each have their own S&P 500 mutual fund, and they'll have the same companies in them. So there's no difference in the companies which are in these index funds. So again, with these index funds, we're just going to choose the index itself. It's going to decide what companies go into the fund. So we're not paying anyone to choose our companies for us. Well, what does this mean? Well, it means that the costs of index funds are much, much lower because we don't have to pay someone for their stock picking ability. We just have to pay someone to, administer the fund efficiently. Okay. So index funds have much lower costs. You'll see the costs on index funds are about 10 times less. So we want to focus on index funds because they're much lower in cost, but more importantly, they outperform actively managed funds. So these index funds have lower costs and they perform better. And that's why we want to focus on them. Again, so most of your funds are actively managed. 95% of these actively managed funds fail to beat their market index. So again, only over 15 years. So only 5% of these actively managed funds actually do better than the index. and actively managed funds cost more. So again, for the most part, we want to avoid actively managed funds because they're more expensive and their performance is worse. Now, unfortunately, as we'll talk about, in a lot of your 401k and 403b plans, all you have are actively managed funds. And why don't you have a lot of index funds? Well, because the financial service companies, they don't make a lot of money off of index funds. And that's why most of your 401ks will be actively managed. But again, you want to avoid actively managed funds, and we want to focus on the index funds because they perform better and they're cheaper.
Hello?
Okay. If you have any questions, just let me know. Let me see, just let me check chat real quick. Okay, thank you. Okay, so when you purchase mutual funds or when you purchase another form of these collections called ETFs, you always want to look at the fees. So as you're going to see, fees are really important, especially in retirement accounts, because small differences in fees make huge differences in the value of your account. So we want to focus on fees. So all mutual funds charge fees, and so we want to see what these fees are before we sign up for it. Again, all mutual funds charge what are called management fees, and these just pay for the administration of the fund, right? So when you buy shares, there's, bookkeeping on the back end. When you receive dividends, they had to give you dividends. So there are some administrative costs in running these funds, and that's what the management fees cover. And generally, the fees are given as a percentage. So these fees, and I'll show you in detail, they're called net expense ratios, and they're given as a percentage. So, for example, most index funds have a net expense ratio which is lower than, let's say, 0.05%. So what does 0.05% mean? It means basically for every $100 you invest, it costs you a nickel. Okay. Most actively managed funds, the average cost on those is about 1%. Right? So for an actively managed fund, if it's 1%, for every $100 you invest, you would be paying $1. So you can see how these fees impact you, right? Index funds, you're paying a nickel per $100. Actively managed funds, you're paying $1 per $100, 20 times more. So again, this is why index funds are so much cheaper, even on just one dimension. And we'll see that. Some funds charge you what are called loads, and you can have an upfront load or a back load. And a load will be given as a percentage. So let's say you invest in a fund with a 5% front load, what's called a front load. What that means is for every $100 you invest, your broker keeps $5 and only $95 goes into the fund. So you can see if you invest in a fund that has a 5% front load, you're negative right away because they're taking 5% off the top. So you're already 5% in the hole before they even invest for you. Some funds charge what are called back loads. And so, if you have a fund that has a 5% back load, it means for every $100 you withdraw, you only get 95 and your broker gets to keep 5. So you can see loads are, you never want to pay loads. There's no reason for you to pay a front load or a back load. And if someone tells you to invest in a fund that has a front load or a back load, you tell them no. Because there's no reason why you should be paying any loads, ever. And you really want to watch this on annuities. Because if you get in annuity, the funds that they offer you, which by law are different than mutual funds slightly, a lot of them will have front loads and or back loads. And again, you never want to invest in any mutual fund that has a load, ever. Some funds charge what are called 12B-1 fees. And these are fees which the fund can charge you for basically covering their marketing expenses. So again, these financial service companies got this law passed that's saying they can charge you for their marketing, which is crazy. A 12B-1 fee is generally given as a percentage, and most funds that charge it, they charge you 0.205%, which means that you're paying an extra quarter for every $100 you invest. There's no reason why you should be investing in funds that charge you 12B-1 fees. You really want to avoid these. Now, sometimes you can. If you have a retirement account from TIAA-CREF, they charge 12B-1 fees on all their funds, and you're stuck with that. But generally speaking, you don't want to pay any 12B-1 fee. That's, an extra quarter for every $100 you invest that, you shouldn't be paying. Okay. So basically what we want to find is we want to find the low-cost funds, which don't charge any loads, don't charge any 12B-1 fees, and they have very low management fees. And those are the ones we're going to focus on. Because again, we want all our money going to workforce. We don't want to be paying brokers. Okay, so think of it. I mean, when I was growing up, VHS tapes, well, I was probably in college when the VHS tapes came out, right? So again, if you wanted to watch a movie at home, you would go to Blockbuster, get a VHS tape, put it in the tape machine, and you're watching it, right? And then we had this incremental improvement in technology, and we went from VHS tapes to DVDs. But it was the same idea, exactly the same, only it's a different technology. Now we're going to go to the store, get a CD disc, and we're going to take that home with us and watch the movie that way. Same process, we're doing the same thing, only we're using a new technology. And now, right, the new technology is streaming. So now we don't even have to have the physical film with us. We can stream it. Okay, but again, we're doing the same thing, right? We're watching a movie at home. So we went from VHS tapes to DVDs to streaming. But we're doing the same thing, which is watching a movie at home. Okay. Exchange-traded funds are the new technology to mutual funds. So again, we're doing the same thing. We're just using a new technology. So exchange-traded funds, like mutual funds, represent a collection of companies, right? It's the same idea. We're buying a collection. We can buy a collection through a mutual fund, or we can buy a collection through an ETF. Okay. And there's various reasons why the industry shifting to ETFs. So last year was the first year that ETFs took in more money than mutual funds. So again, mutual funds are the old technology, ETFs are the new technology. They do exactly the same job. And again, the field is shifting towards ETFs. Again, ETFs cover all major asset classes. You can find stocks, you can find bonds, you can find commodities, you can find gold, and so forth. You have passive ETFs, right? So you can go to Vanguard and you can invest in an S&P 500 index mutual fund, or you can invest in a S&P 500 ETF. There'll be the same companies in those two funds. They're just about exactly the same. It's just a different technology. Okay. And then you can also have actively funds where, again, a fund manager would choose what companies go into that collection. Again, like mutual funds, ETFs are controlled by financial companies. So if you want to invest in the S&P 500 ETF, you could buy one from iShares, which is owned by BlackRock, which is the biggest asset manager in the world. Or you could go to Vanguard, invest in theirs, or you could go to Schwab, or you can go to Fidelity, or you can go to Wells Fargo. So each ETF is, like a mutual fund, is controlled by a financial service companies. Now, the biggest difference between ETFs and mutual funds are, for various reasons, mutual funds do not trade during the trading day. So we said last week, the stock market's open from 9:30 to 4 every Monday through Friday. If on Monday you decide that you want to buy some S&P 500 mutual fund, at 9:30 when the market opens, if you put in a bid to buy that fund, it sits there the whole day, because mutual funds do not trade during the day. Their price is set after the market closes. So again, at 9:30 when the market opens, you could put in a trade for a mutual fund. It will sit there the whole day. And then after the market closes at 4 o'clock, they will execute your trade. ETFs are different. ETFs trade like stocks. So if you decide to invest in the Vanguard S&P 500 mutual fund, you put in a bid to buy at 9:30, it'll sit there the entire day. If you decide to buy a Vanguard S&P 500 ETF, when you put in your trade at 9:30, it'll trade by 9:30 and 10 seconds. So ETFs trade during the market day. Mutual funds don't. And that's the main difference between the two. There's some other minor differences, but that's the main difference. Okay. So again, why would this make a difference? Well, let's say that when the market opens, it's up like 400 points. You have a mutual fund and you decide, well, I'm going to take some of my profits and I'll sell some of my shares. If you put your sell order in at 9:30, it sits there. It doesn't get executed until 4 o'clock. At that time, the market may go from 400 points up to 200 points down. And now you're stuck selling because you put your order in at 9:30. Whereas if you purchase a Vanguard S&P 500 ETF, when you put your order in at 9:30, it's executed by 9:30 and 10 seconds. Okay. So again, ETFs trade like stocks. When you put your bid in to buy, it'll be executed right away. Where mutual funds, they sit there the whole day. So if you're using mutual funds, you really don't want to put in buy or sell orders till about 3:30 in the afternoon, because then you know what the market's doing. Okay. So again, the main difference between mutual funds and ETFs: mutual funds do not trade during the market when the market's open. ETFs do. Any questions on it?
Hi, I have a question.
Yeah.
So passive funds are the Vanguard and S&P 500?
Passive funds are, index funds. So if the S&P 500, you've probably heard of the Dow Jones. There's a Russell 2000. There's the S&P Mid Cap 600. So
Okay.
these are all these different indexes, and any index is called a passive fund.
Okay.
Okay?
Because it's just functioning and doing what it's doing, so it's passive versus.
Yeah, so it's more like, you could get let's say that you want a large cap equity fund. You could get one which is actively managed, which means some fund manager is deciding what large companies go into that fund. So you have to pay that manager for their expertise, because in theory, they're choosing companies which should do better. Whereas if you buy an S&P 500 index fund, they just take the 500 companies that are in the index and put it into the fund. And this is why it's called passive, because no one chooses what companies go into that fund. You just duplicate the index. So like the S&P small cap 600 index, right? If you buy an ETF of the S&P 600 small caps, they're just taking the 600 small companies in that index and they're putting it into the ETF. And that's why it's called passive, because no one's really choosing them. Does that
Okay,
help?
got it. Yes, it does. Thank you so much.
Okay, yeah, and just keep asking questions. Yes.
I wanted to I wanted to ask you, Professor, if you would be able to, how would we as, say, the graduate class, how would we select index ETFs ourselves? Is there a way for us to select ETFs that are indexed?
Yes.
And, you know, because, I mean, you have to know which ones are indexed in order to get the biggest bang or the lowest cost. And if they're indexed, we know that they're low cost, right?
Exactly.
Like Charles Schwab has some index funds, Vanguard has some index funds, right?
Yeah. Fidelity has some. Yep.
Yes. So all of these big brokerage houses have index funds, but
Yes.
those index funds are usually comparable to the Dow or the S&P or the Russell,
Yes.
right?
Yeah.
So,
Yeah. And all index funds are listed as index funds. They'll say this is an index fund.
okay, so if I just select an ETF, say a Charles Schwab large cap, right?
Yeah. Yeah.
When I put that into Google search and it comes up, I will see someplace on that homepage that it's an index fund.
Yes. And we'll go through that. I'll show you that.
Thank you.
You're welcome.
Sorry, I have one other question.
Sure.
So, Professor Keith, how can you tell when the funds are overlapping? Because, say, if Vanguard has their own funds, but it also could reflect like the S&P 500, like how do you know that it's not like what you're investing isn't just overlapping each other, so you just pretty much still have one
Right.
thing versus.
Yeah. And so we'll look at that. And so you want to look at the holdings in each fund. And I'll show you how to do that. Okay. Okay. So first of all, why is the industry moving to ETFs? First of all, they're lower in cost. So they save the financial service companies money and they save you money. Okay. So again, you could go to Fidelity and they have an energy ETF and it would cost you 0.12%, which means you're paying about 12 cents for every $100 you invest. Or you could go to Fidelity and they have an energy portfolio mutual fund. The companies in each of these is exactly the same. They're exactly the same. But you can see the cost of this is 0.8 or 80 cents per 100. So again, we're moving towards ETFs because they're cheaper for both the financial service company and for the consumers. And they also trade during the day. Mutual funds don't. And ETFs have some slight tax advantages. Okay. Disadvantages. So there are these trading costs. So before, because they traded like stocks, you used to have to pay commissions. But now most brokerage are giving you free trades, as we'll see. So ETFs and mutual funds are basically costing you the same because there's no trading commissions now. Again, there are these management fees, but again, ETFs generally have lower management fees than mutual funds. Now, the other disadvantages is ETFs are used more by day traders, right? Because if I'm a day trader and the S&P 500 is down, let's say 200 at the opening, I can buy an S&P 500 index ETF. And then if the index is higher, let's say it's 100 points higher at the close, I can then sell those ETFs, only holding them for less than a day, and make a profit on it. And that's what day traders do. So again, day traders are using ETFs. They can't use mutual funds because mutual funds don't trade during the day, but they do use ETFs. So there's a little more volatility with ETFs. So these are some of the types of collections you can buy, either mutual funds or ETFs, right? So we talked about the 500 index, the 500 biggest US companies. You can buy in emerging markets. Emerging markets are countries where their middle class is developing. So China, Brazil, India, Nigeria, Egypt. These are all emerging markets. Again, why would we want to be invested in emerging markets? Well, first of all, diversification. But second of all, because these economies are growing a lot quicker than we're growing. So last year, our economy grew by about 3%. Cambodia's grew by over 10%. So emerging markets are seeing higher growth. You can invest in real estate. So a REIT is a real estate investment trust. And a REIT is just a collection of properties. And then a real estate mutual fund has a whole bunch of these REITs in it. So usually a real estate mutual fund will hold thousands of properties. So, people say everyone should own a house. That's not true, but everyone should own property because property is a hedge against inflation and it's a diversification away from stocks. So these REIT mutual funds have thousands of properties, and they also throw off lots of income. 95% of their income must be given back to the fund holder, which is you. So if you're looking for monthly income, you may consider a real estate mutual fund. If you want to buy treasury bonds, right, 10-year bonds, 5-year bonds, 20-year bonds, 30-year bonds, you can find a mutual fund for this. And again, what you'll be buying is you'll be buying a collection of government bonds. You can buy other types of bonds, high yield bonds, corporate bonds. Okay. You can buy gold, you can buy silver, you can buy oil, you can buy natural gas, you can buy hog bellies, you can buy corn. Again, any type of commodity you want to buy, we can find a mutual fund for. And finally, I'll talk about this later, are what are called sector funds. So most people try to identify what companies will do well in the future. We want to identify what sectors will do well because it's easier. And then we're just going to invest through a sector fund. So for example, in my retirement account, I have a lot of healthcare sector funds. Why? Because I think healthcare is going to keep growing quicker than the general economy because people are getting older, they're living longer, and so forth. So I could spend hours deciding, well, what healthcare company should I buy? Or I can just invest in the entire sector and just buy a healthcare sector fund, and this will have all companies in healthcare in that fund. It's much easier. So we're investing in sectors, we're not investing in individual companies. So other sectors I'm invested in: cybersecurity, cloud computing, electric vehicles, clean energy, right? Again, these are all sectors which I believe will keep growing in the future. And instead of investing in one company, I'm investing in the entire sector. Okay, so let me go, before I do this, let's go through some of this ones. And let me show you. So, let me go to Vanguard once. And I'm just using Vanguard as an example. Okay, so this is the Vanguard S&P 500. Oh, sorry. Okay, so this is the Vanguard S&P 500 ETF. So this is called the trading symbol. When you trade, you're just going to put this symbol in, VOO. And this symbol is unique to this ETF. So again, this would be an index fund. We're just putting in the 500 companies in the S&P 500 index. This is a symbol that we're going to use to purchase it. We would just type in VOO. You can see the management style is an index. It tells you it's an index. These are large cap companies, right? They're all large companies in the S&P 500. You can see that the expense ratio is 0.03%. So again, it's costing you about 3 cents for every $100 you invest. And that's all it costs you. There's no trading commissions. There's no trading fees, nothing. This yield is your cash back. Think about this as your cash back, right? So remember last time we talked about when you purchase stock, you become an owner of the company and you have legal rights to their profits. So these 500 companies are giving dividends off, which are your share of the profits. And then the fund's going to take all the dividends from the S&P 500 companies and they're going to distribute it to their fund holders. So what this would mean is you would be getting cash back of about 1.56% from this fund. Again, why would they give you the cash back? Because it's your earnings, because you're a shareholder. Now, again, you can see the price of this fund is pretty high, $387 a share. So most of us won't be buying whole shares, but as you'll see, you can buy partial shares. And that's why I like Vanguard. They're low cost and you can buy the partial shares. Okay, this is just information. You can see your year-to-date return is over 11%. So far this year, you've made over 11%. And again, what did you have to do? All you had to know was, oh, I should put money in an index. And you would have been making 11%. Now, this is what I sort of want to show you is, look at your minimum investment is $1. So when you buy VOO, you don't have to buy a whole share and spend $387. You could put in like $1 or $5 or $10. So again, you can put in these small amounts of money and still take the advantage of being in this fund. Okay, and that's why I like Vanguard, because with their index ETFs, you can buy by the dollar and you don't have to buy by the share. So when you incrementally put money in, you can put in smaller amounts of money. You can see the return year to date, it's 13%. A 1 year return, you have over 21.33%. So look at this is what I mean. It's pretty easy to get wealthy in the market. You don't have to know too much about the market. You just have to know you should put money into this index, and you would be getting a return of 21%. Over the past 3 years, you would have gotten over 10% a year. This is the yearly average. Over 5 years, you would have still gotten close to a 10% return a year. And you can see over the past 10 years, you would have gotten a return on average of like 12% a year, which means that you're doubling your money every 6 years. Every 6 years, you're doubling your money if your money was in this fund. So again, this is the thing about index funds. You can get a very good return. This is a really good return without knowing very much. All you have to know is, oh, I should be in this index. Any questions on that? This is the market price. This we don't have to worry about. You'll see historical prices. Usually, if we look at the 10-year, usually we want to look at a 10-year performance. So you can see back in October of 2013, a share would have cost you under $161 per share. So you can see over 10 years, your price per share has jumped from 161 all the way today. It's at 392. And at this point, look at it, was at 436 within 10 years. So within 10 years, you're more than tripling your money. And again, what did you have to know? All you had to know was, oh, well, I should every once in a while put money into this index fund. Now, again, if we look at the ETF, we should expect 500 companies. We have 505 here. Again, 505 simply means that that we have 5 options. The extra 5 are basically options to protect on the downside, right? This is just, this is telling you how well you're doing. So why do we want to invest in collections? Well, first of all, we get diversification, right? So we're diversified across 500 companies. We're also diversified across different sectors. So not all sectors do as well. So right now, real estate's doing really bad. Energy's doing really good. Last year, if you looked, real estate was doing good. Energy was doing bad. So you're diversified across sectors. You have companies in communication, consumer discretionary, staples, energy, financials, healthcare, industrials, IT, materials, real estate, utilities. Again, you're represented in all these different sectors of the US economy. So that's one form of diversification. Our sectors, you're in different sectors, and you also have these different companies. Okay. Now, remember, you have 500 companies. These are your top 10. So you can see your top companies: Apple, Microsoft, Amazon, NVIDIA, Alphabet, Tesla, Facebook, Alphabet again, Berkshire Hathaway. This is Warren Buffett. Exxon Mobil, this is energy. And if we wanted to see all 500, we would just click on here. Now, these are what's called market weighted, so not each company has the same weight. So you can see here, Apple has the biggest weight. So if you think about this, one way you can think about it is, for every dollar you invest in this fund, 7 cents goes to Apple. 6.5 cents goes to Microsoft. 3 cents goes to Amazon, and so forth. Okay. So again, you can see these are all major companies. They're all doing pretty well. And again, you can see the percentages. Any questions on this? And here you see these are their dividends. So you can see this year, this fund gave you $1.49 a share. At the end of March, they gave you $1.58 58 cents a share in July or at the end of June. This was quarter two. And then quarter three just ended. And so they gave you $1.49 a share for a quarter three. And then in quarter four is generally your biggest dividend. You can see in 2022, your quarter four dividend was $1.67 a share. So again, this would pay you cash back 4 times a year. And this is your per share amount. And again, most ETFs will be laid out like this. Any questions on this one? Okay, so let's look at another one. And I'll give you a full list of the Vanguard ETFs. This is called the Total Stock Market ETF. So you can see the symbols are VTI. And basically what this means is you're basically buying the entire stock market. You're buying thousands of companies at one time. Again, you can see this is an index. Expense ratio is low. You have a yield of 1.54%, which is your cash back. This is the price per share. Index, this says the same thing. Again, notice it'll take $1. Performance-wise, I mean, this is still doing pretty good. Year to date, you're making over 12%. Your 1-year return is over 20%. Your 10-year return is over 11% per year. That's per year. So you'll be doubling your money between 6 and 7 years. Again, very low expense ratio. This we don't need. This here, if we look at the 10-year. So it comes up here. Here we go. So 10 years ago, this would have cost you $91 a share. And today you can see it costs you $223 a share. So the price has more than doubled in 10 years. Again, that's a very, very good return, right? And again, what did you have to know? All you had to know is, well, I should throw money into these indexes at certain points in time. Now, look at the number of stocks. You almost have 4,000 companies, right? So this is about 7 times as big as the S&P 500. Again, you're buying the entire stock market. You're buying big companies, small companies, medium-sized companies. So again, there's lots of different companies here. Okay. Again, you're diversified across different sectors. Now these holdings, these top 10 holdings will be the same because these are the most heavily traded stocks. But don't forget, you have 3,890 other companies in here. So this would be another index. Again, and you can see what their distributions are. So let me show you one more. Let me show you. So we can classify companies by their size. So S&P 500 are our large cap companies. They're all these big companies, but sometimes small companies act differently. So this would be an index for small companies. So there's no company in this index, which is also in the S&P 500 index. So the question was asked, how do I know I'm not overlapping? There's no overlap between small caps and large caps. Again, this expense ratio is slightly higher because it's more expensive to trade some of these smaller companies, but it's still low. It's a nickel for every $100 you invest. Again, your yield, you're getting about 1.65% cash back. Index, everything here remains the same. Again, you can invest $1. You can see small caps haven't been doing quite as well. So your 1-year return would be 12.5. Again, this is lower than your total market or your S&P 500. Even over 10 years, though, you're about making the 8% return per year on average. So over the past 10 years, large caps have outperformed small caps. But again, that's not always true. Sometimes small caps will outperform. Again, you can see it's cheap relative to the average, which is $1. This is the current market. We don't need that. Again, this probably won't look as good. Let me see what the 10-year is here. So this isn't bad. So 10 years ago, a share of this was $105 a share. And now today it's $189. At one point here, this was 2021. You can see it increased by over 100% because it was $230. So again, over the 10 years, you can see this has done very well too. I mean, if you leave money in the market for 10 years, you're going to do well. Here you can see there's 1,446 companies. So you still have a lot of companies. The market cap here is much smaller, 5.8 versus for the S&P 500, it's over 60 billion, I think. So again, these are very small companies. Again, but you're still diversified across the different sectors. What will be different is your top holdings, right? So most of these we probably haven't heard of because they're so small. Targa Resources, it's probably a minor, I would guess. Energy company, Reliance, this is steel. Here's Booz Allen Consulting. This is insurance. So you can see, you don't know a lot of these names because, small companies are small companies. They're not as well known. You can also see that the holdings much smaller, right? So in the S&P 500, the top holding was Apple. It had 6.49%. Here, your top holding has less than 0.5%. So again, these are much more spread out. You don't have this concentration. Okay. And then again, you can see the dividend rates. Okay. So these are sort of the ETFs. We'll go through this next week too. What I've asked for is I've asked for all of Vanguard's index ETFs. Right. And then they give us this chart. And again, these are all ETFs of Vanguard. We want basically index. So we're just going to click on that. And now these are all index ETFs. Again, you can see how low the expense ratios are. Right. So, one other thing I wanted to show you was, I'll talk about this next week too. We can break stocks down into growth versus value. Let's look at this growth index. So this is the large cap growth index. Again, you can see that. What I want to show you is a return here. I mean, look at your return. Your year-to-date return is 28%. So again, what do you have to know to get 28% return? Just you should throw money in index funds. You can see your 1-year return is still 28%. Your 10-year return is 13.5%. This is annually, 13.5% annually. So you're going to be doubling your money in less than 6 years. And again, all you're doing is you're buying an index fund. Again, these are all this, blah, blah, blah. Our 10-year should be huge. So look at 10 years ago, you're paying $88.20 a share. And now today, you're paying $289 a share, and it was well worth over $300 a share. So you more than doubled your money. So again, if you're going to leave your money in the market for 10 years, you should be making returns like this. Again, you can see this has 222 companies in it. Again, you're diversified across sectors, although look at, you have a lot of weighting in technology, because most technology companies are what are called growth companies. And then these would be your holdings, right? Notice that Warren Buffett's company is not in the top 10 because that's a value company. That's not a growth company. We don't see ExxonMobil, who's in the top 10 of the S&P 500, because that's a value company. So again, we're seeing Visa now, we're seeing Eli Lilly. And then these are the ones that we also saw in the S&P 500. But you can see, remember in the S&P 500, Apple was about 6.5% of the fund. Here, Apple is almost 13%. So if you believe Apple is going to do well, you would want to invest in this fund more because 13% of it is invested in Apple. Okay. So again, next week, I'll go through, the different index ETFs, but you can see there's, quite a few of them. They'll all tell you that they're indexed, and you should all see this low expense ratio. Any questions on that? If not, I just want to finish up with this slide, and then we'll have to move on to the next part of the session, which is the investing club. So why do we want to invest in collections? Well, the main reason is diversification. We're going to see diversification reduces your risk. And by definition, you're diversifying, right? You buy one share of the S&P 500 index, you're buying 500 companies, not one, you're buying 500. You buy one share of the let's say, total market, you're buying over 4,000 companies. So again, it's much less risky because you're buying collections, not individuals. These indexes are all run by professional managers, right? We don't know that much about the market. Plus, we're busy, we're working, we have our families, we are socializing, going to church. And 24/7, your money's being watched by a professional manager. We can find ETFs or mutual funds for just about any asset class you want to invest in. Stocks, bonds, commodities. There's oil mutual funds, which just have barrels of oil in it. There's gold mutual funds that just have gold bars in it. So again, any asset you want to purchase, we can find a mutual fund or an ETF for. Relatively low minimum investments, right? I just showed you with Vanguard's ETFs, you can start with $1. People think you need thousands of dollars to start investing in the market, and you don't. You just want to start investing because of a compounding. It's transparent. Every day you can go to the internet and you can see how much your investment's worth. Liquid. If you buy an ETF and you sell, there's a 3-day waiting period. So you get your money in 3 days, which is pretty liquid. Think about a house or something. If you invest in mutual funds, you get your money the next day. So with mutual funds, there's no what's called a settlement period. You get your money the next day. With ETFs, there's a 3-day settlement period. They're audited. The US government protects you against fraud and theft, just like they do with banks. They don't protect you against market losses, but they do protect you against fraud and theft. And usually most of these funds will automatically reinvest your dividends because that's how you increase your returns. And that's all free. So you can see there's lots of advantages in investing in these collections. Okay, I have to stop here. Are there any questions on that? Okay, and we'll go more into this, but again, the idea is when we invest, we're buying collections. It's much safer. Our performance will be better. Okay, and we'll continue down this line. I'll show you greater details next week or in 2 weeks, our next meeting. Any other questions? All right, so it's 11:05. Let's take just like a minute break and then we'll begin the second part of our session. I just want to get something to drink and then I'll be right back. Okay, welcome back. We're going to start the second part of our program, which is our sort of advanced education investing group. For those of you who are new, just feel free to ask questions. So let me bring that up. Okay. So again, this is our information. This is all up to date. if you want to contact us. If you want to schedule a one-on-one meeting with me, just go to this link here and just, grab a time and a date, and you'll be sent a Zoom room invite. And again, we never charge for our services, so these services are free. And a lot of people talk about their retirement accounts or what they can do for their children. Anything you want to talk about, we can talk about. So that would be this here. If you want to get on our mailing list, Lizzie is sort of a director of operations for us, and she can answer your questions or put you on our mailing. This is in the flyer for this meeting. If, it's not too late, we still have 4 sessions left. So feel free to give this to your friends or family. And you just have to scan the QR code here, register, and then you'll receive an invite for, it'll be November 11th, our next meeting. Okay, so these are mutual funds, and these are the mutual funds that we started with, about 10 years ago. And basically, we're showing you the price per share 2 weeks ago. We're showing the price per share last week, and we're showing the price per share yesterday.
Excuse me. I just have one question.
Sure.
Are those meetings recorded to see them again?
Yes.
Okay. And so the recording is in that list, that first list that you gave us?
Yeah, and I believe that if you're on the email list, the recording is actually sent to you.
Okay, thank you.
But you can also find them on our website.
All right, thank you.
Sure. So again, this is a price 2 weeks ago per share. This is a price last week. This is a price yesterday. And again, we're trying to give you a little idea of what the market's doing. So 2 weeks ago, you can see the S&P 500 index per share. This is Schwab. This is their mutual fund, was $66.05. Last week was $67.83 a share. Yesterday, we closed at $66.48 a share. The total market index mutual fund was at $72.64 a share 2 weeks ago, $74.63 a share last week, $71.85 a share yesterday. International index was at $20.53 a share 2 weeks ago, $21.28 a share last week, $20.34 a share yesterday. Balance fund, a balance fund, if you have a target fund and your 401k, it's a balance fund. You have stocks and bonds in it. So 2 weeks ago, we were at $14.85 a share. Last week, we were at $15.15 a share. Yesterday, we ended at $14.68 a share. Global real estate, these are a collection of REITs, or real estate investment trusts. So you're probably controlling about 10,000 properties in this fund. 2 weeks ago was at $5.56 a share. Last week was at $5.79 a share. Yesterday, we closed at $5.44 a share. Small cap index, these are small companies. 2 weeks ago was at $28.06 a share. Last week was at $28.78 a share. And yesterday it closed at $27.28 a share. Emerging markets, again, these are like, China, Brazil, Nigeria, Egypt, Cambodia, developing countries. 2 weeks ago was at $8.10 a share. Last week it was at $8.35 a share. Yesterday we closed at $8.08 a share. Mid-cap index, again, these are medium-sized companies. Etsy would be one. Five Below would be one. 2 weeks ago is at $52.14 a share. Last week was at $53.65 a share. Yesterday closed at $51.17 a share. Then we have healthcare. 2 weeks ago, healthcare, this is a sector. So this would be a sector fund. The only companies in this fund are in the healthcare sector. 2 weeks ago was $24.55 a share. Last week was $25.22 a share. Yesterday we closed at $24.63 a share. So you can see we have a downward trend in the market right now, right? So 2 weeks ago, it went up, and now the price is going down. Again, 2 weeks ago, the price went up, now it's coming down, went up, now it's coming down, and so forth. So again, right now we have a downward trend in the market. And some of these, right? Total market, international, balance fund, global real estate, small cap. The price yesterday was lower than it was 2 weeks ago. Again, so the market's on this downward trend. Okay, this is what we show you. This comes out every Friday, and it shows you the major averages, right? The Dow Jones, S&P 500, NASDAQ, S&P Mid Cap 400, and then your Russell 2000. So these are large caps. These are mixed, but most heavy weighting is on large caps. When I talk about large caps, again, a cap is what is the company worth? How do we find that out? We take how many shares they have and we multiply it by the current price per share, right? And that tells us how much the market values the company at. So, you know, something like Apple is trillions of dollars. It's worth trillions of dollars, right? Where a small company may be worth, you know, $10 million. Okay. So again, these are large caps. This is mixed. These are medium-sized companies, and these are small caps. So we're sort of trying to cover the entire market. So first thing you want to look at is, well, was the week up or down? And you can see the week was a down. Every major index lost. And then this column here shows us the change year to date. So far you can see any shares you had in a Dow Jones Industrial Average would be flat for the year. Any shares you had in the S&P 500 on January 1st, each share would be worth 10% more. For the NASDAQ, it would be worth 24% more. For the mid cap, you would have lost about 1.5%. And with the Russell 2000, you'd be off over 4.5%. So you can see, right? The large caps are clearly doing better than the small companies. And this changes from year to year, but right now, the large companies are doing better. Okay. And you can see the NASDAQ is doing really well. It's up 24%. Okay. This is the summary from the previous week. You can see from the previous week, all our averages are off even more because we had a losing week. You can see this second week in November, again, the small companies lost, the big companies gained. But again, you can see that we've come down, right? So the Dow was at 33,670. And now the Dow is at, sorry, I have some car out there. And now the Dow's at, just a second here. It's at 33,127. So we've dropped about 540 points since October 13th. S&P was at 43.27. Now it's at 42.24. So it's dropped about 100 points. NASDAQ was at 13,407. Now it's at 12,983. This is the first time the NASDAQ's been less than 13,000 in month. But you can see it's dropped over 500 points. And the Russell was at 1719, and now it's at 1680. So again, you can see for the last 2 weeks, the market's on a downward trend. The market's been on a downward trend since the beginning of August. August and September. September was the worst month of the year. August was bad, and October is going to be bad. This is where we were at the beginning of October, and you can see we were in better shape. Again, you can see it was a mixed week. All the averages were down except for the large caps here. Okay, but again, we were in much better shape. We were higher on all our averages. Okay, now we're going to go back to the beginning of September, and you can see we've really sort of gone down. I mean, the Russell's lost what, about 7%. NASDAQ is down about 7% too, right? Because it was up to 31.5, and now it's at 24, I believe. Again, you can see in this week the market was down. September was the worst month we've had all year. But again, and so you can see, we can say, well, from September 9th, the market's on a downward trend, and it is. Okay, this is where we were at the beginning of August, and it's the same story. I mean, look at the Russell was up over 11%, and now it's what? Was it 5% down? 2% down, 2 1/3. So, I mean, we've lost over 13 points here. Again, you can see the first week in August, it was a down market. But again, we're doing much better for the year. Okay, this is where we were at the end of Q2, at the beginning of Q3. And again, you can see the market's been down. So Q3 was a down quarter, because now we're in Q4. So you can see end of June, this was a positive week. Everything's positive. We were doing much, much better. Look at NASDAQ was up almost 32%. S&P's up almost 16. So, the market's come down since June 30th. This is where we were in February. Now you can see in February, the market's up since February. Again, this is a down week here. Well, I should say the market's up except for the small caps. The small caps are down, but you can see the Dow, this was at the beginning of March, right? Was at 32,816. It's now above 33. S&P was at 3970. It's now at 4224. Again, what do these numbers here mean? We're going to take all the prices of the companies in the Dow Jones, and we're just going to sort of add them together. So this is telling us how well is this entire collection doing. Okay, you can see the NASDAQ was under 11.5, and now it's almost at 13. So again, the market's been up. The only one that's been down since March 1st is the Russell, because we were at 1890 and now we're at 1680. So again, we've been doing pretty well since February. This is where we were a year ago. So again, we want to sort of get some idea of how we've gone during this year. And you can see if we look a year back, we've certainly done better in the Dow. We've certainly done better in the S&P 500. We've done better in the NASDAQ. We're higher in the mid cap, and we're even higher slightly in the Russell. So in this past year, the market's up. And the market's up, pretty, the markets had a good run in both of these two here. Right. So again, we're just trying to give you an idea of how the market's moving in these various time intervals. Any questions on that? Okay, then I want to go to our articles, and this is an article that we talked about last time. And I wanted to bring it back because they talked about the support levels. And this was an article about these analysts from Bank of America. And they're, again, and they're saying that we have to have a capitulation for the market to go back up. And what that simply means is everyone stops buying and everyone's selling. And we're sort of getting to that point. We're getting to the point. I mean, the market dropped a lot, but we're not quite there yet. right? But they were talking about a support level, and we talked about this, of 4330. So again, if the S&P 500 index stays above 4330, it'll keep going up. That's what these support levels mean. 2.5 weeks ago, it closed at 42.58. Today, Friday, it closed at 42.24. So you see, we're below the support level, which means it's a higher probability that the price will keep dropping. Now, again, we have this downside risk of 4,200. We're at 42.24. If we break 4,200, we're going to go down to probably about 41.14. That would be the next support level. So again, if you want to sort of try to anticipate what the market's going to do, you want to look at the S&P 500, because that's looking at the stock performance of the 500 biggest companies. As long as we're below 4330, the market will not go too much higher, and it will probably go lower. Okay. We're above 4200, but if we hit 4200, we're 24 points from it. We could go as low as 4114. And this is before the end of the year. Now, again, everyone's still predicting what they call a Santa Claus rally. So even these analysts are saying we should be higher than we are today by the end of the year. But first, we sort of have to go down to 42,200 or below. And again, what does this mean when the market's going down? There's more sellers than buyers, so we're getting closer to this capitulation where all the buyers just leave. They say, we're not buying because the market keeps going down. We're giving up on the market. So we're not there, but we might get close. So again, you want to keep reminding yourselves of, again, the upward support is 4330. If we're above that, there's a higher probability the market will keep going higher. If we drop 24 points now, like next week, and we go below 4200, we're probably going to go down to 4114, which would be about a 5% drop from where we are today. Okay. Okay, so we've been talking about these Series I bonds. Sorry. And I bonds are just saving bonds which protect you against inflation. So their rate depends on the rate of inflation right now, and they change the rate twice a year, November 1st, April 1st. Right now, the rate's at about 4.86%. After November 1st, it'll probably go higher than 5%. So if you're going to buy these, you should wait until after November 1st because you'll get this higher rate of 5%. Again, I don't have too much time. We've talked about these a lot before, but these have a fixed rate and a variable rate. Again, they protect you against inflation. So if inflation gets higher, the rate just increases. Again, these are savings bonds, basically. They're absolutely safe. The variable rate's going to increase from like 3.38 to 3.94, which is good. And that's why we're going to see the rate increase. But there are, locking in 5%, that's a good rate to lock in. But there's other ways you can lock them in. You can lock in this rate not only with I bonds. And I just want to look at this quickly. So for those of you who have been with us before, whoops. Sorry, hold on just a second. There we go. So this website's called Treasury Direct. It's a government website. You're dealing directly with the U.S. government. So if you're going to buy bonds, you know, this is one way of buying them. Again, you can see the Series I savings bonds are paying you about 4.3% now. After November 1st, this is probably going up to 5%. Okay, so it'll tell you what rate you're getting on these savings bonds. Now, the thing about Series I savings bonds is you want to hold them for at least a year, or there's a big penalty. And if you sell them back to the government within 5 years, there's a smaller penalty. It's a small penalty, but there's still a penalty. So, but you know, you'll be getting about 5%. But if you look at, instead of buying these, you could buy other types of bonds. And so if we look at these bonds, so you can see, so this is a 4-week bond. So this would be, you would be lending money to the US government for a month, and they would pay you 5.416%. Or you could borrow money for them for 6 months, a 20-week bond, 26-week bond, and they'd be paying you 5.57% risk-free. I mean, that's high, right? You can buy basically a 3-month bond, and they would pay you over 5.5%. So you can see, I mean, the Series I bonds will pay you 5%, but you could get shorter term bonds, right? Here you're only lending the money for a month. Here it's 2 months, 6 months, and you begin a much higher percentage rate. And remember, this is all risk-free because you're dealing with the US government. Okay. So again, because of inflation, these government bonds are paying you a good return now, risk-free. Okay. So this would be another choice where you could get these high rates over 5% risk-free. Okay. Any questions on that?
I have a question.
Sure.
So looking at the auctions,
Mhm.
how do you determine, so how does that work? If you say, for instance, we go into the auctions, these are already done, right? So you can't
Yeah.
do this. But if we went into auctions and we looked at what's available, how does the government then, well, how do you tell when the issue date, how do you tell if you have actually gotten an auction bond? And I guess what I'm asking is the issue date versus I know what the maturity date is,
Right.
but today it's the 21st. If I
Yeah.
go in to the auction and say I select something, do I have to select it by a certain date or?
No, so these auctions are weekly.
All right.
So this auction was last week, and they'll issue the bond on 10/24.
Which means that even you buy it ahead of the actual issue date.
Exactly.
Like a week before or something like that?
Exactly. A
Okay.
week before. These are weekly auctions.
Okay.
Okay, and you don't know what the rate is until after the auction. So basically what will happen is the government will say, we're going to auction off $20 billion of these 4-week notes. And then all these big banks and financial service companies, they'll come in and they'll say, we'll buy, 100 million of those notes at an interest rate of, 5.4%. So these are called competitive bids. So these big banks are putting in these big bids. They look to see what the bids are, right? And like if they're auctioning off $50 billion, they'll list the bids from the highest to the lowest, and then the bid, which is the marginal bid, or the bid that takes up all the $50 billion, that's the bid that sets the market.
So you don't
So,
know,
yeah, so here you can see someone bid as low as 5.305, but it ended up that they didn't win. Someone else was bidding higher, and so the final bid was 5.416.
Okay.
So again, all these big banks have to put in what are called competitive bids, but you, because you're so small, you put in a non-competitive bid. You're just going to get what the market rate is. So you're going to get the same rate as these big banks and these big financial service companies. You will get their rate. So it's really a good deal for you because you don't even have to compete. You just get their rate.
but you don't know what it is.
You don't know what it is, but again, a 4-week rate, you can see. So the 4-week rate here, when it was issued 10/24, was 5.416. The 4-week rate here, which is the week before, was 5.436.
Okay, yeah.
The 4-week here, which was 5.421. So they're not going to change a lot.
Okay,
So you can look back to what last week's auction was.
okay, thanks.
Okay, anytime. Now, the other thing you can do is you can get, let's look at this. Instead of buying bonds, because of the yields now and stuff, again, so this would be a high yield money market. And you could see, you could put your money in a high yield money market and you would get 4.5%. Zero balance, FDIC approved. This bank here is paying you 5.05%. If you put your money in a high yield savings, you have to put in, $5,000 here where this is zero. This bank here is paying you 5.1%, zero. Again, as long as it's FDIC insured, you really don't care because your money's protected at any of these banks. So again, the other thing you could do is you could put your money in a high yield savings account and you could still get today over 5% risk-free. Risk-free, right? Or you would have your choice of a CD. So look at this bank. This bank will give you a CD for 5.75. I mean, 5.75% risk-free for 9 months. Now you have to put in 1,000 at least, but I mean, 5.75, and you only have to leave your money in for like 9 months. This bank here, Lending Club, they'll pay you 5.65% for 1 year, which is still high. I mean, that's still high. So you can see bank rate's going to tell you what the best rates are. So if you go to your bank and they tell you, oh, well, we'll pay you 3%, it's like, forget that. Why do you want to take a 3% CD where you could get 5.75, 5.65? So again, right now, this is another way of sort of locking in these high interest rates with no risk. Any questions?
Hi,
on
I have a
that?
question. Yeah, I
Yes.
do actually. So this is my first time at this meeting. And so my question is, as far as like doing those types of investments that you just described, right? So investing in the CDs, investing in the high yield money market, investing in these auctioned bonds from the government. Who's doing that and why, right? As opposed to investing in the stock market. Am I doing that because I want a new car or because I want a new mattress? When should I be looking at those things specifically to get the most advantage of those particular financial options?
Okay, so the way you want to think about it is when you put your money in the market, you're putting it at risk.
Okay.
Right? You could lose money there. When you buy a CD or a government bond, there's no risk. And so you want to look at the trade-off. What can I get with no risk versus if I put my money in the market? And generally we say if you put your money in the market, you should expect about an 8% return, right? So again, you can see last year, right, when interest rates were low, these CDs were paying you maybe 2%. So then people are saying, oh, well, I could buy a CD and get 2%, or I can put my money in the market and, you know, probably get an 8% return. It's like, oh, well, I'll put my money in the market. But now as these rates increase, right, now it's like, well, 5.75 risk-free versus an 8%. I think I should put more money in the risk-free at 5.75. So
And
one
then,
thing you want to look at is what return can you get by a riskless investment versus a risky one. And then the other thing that you want to look at, and we'll talk about it, you know, the next time we meet, is if you're going to leave your money invested for a year, you don't want to put it in the stock market. You want to put it in a CD, right? So you only want to put money in the stock market you think you can leave there for 3 to 5 years. And that's the other thing that you want to think about. So how long can you leave the money invested? Over longer periods of time, the stock market's going to give you a better return.
and then are you basically suggesting that, like, so after that 9 months is over, that 4 weeks is over, I basically I get my money back and then I just reevaluate where's the best place to put it at that point? Is that kind of what you're suggesting? Put it
Exactly,
in, get
because
the most bang for your buck, and then reevaluate once your term is up?
exactly. So again,
Okay.
you know, in 9 months, interest rates may have come way down, and then it's like, oh, I'm going to take this money and invest it in the market, or interest rates may have increased, and then you want to roll it over.
Got it.
Okay.
Thank you.
Yeah, that's okay. So those are the general trade-offs you want to think about, and we'll talk more about that also. All right, so let me get back to where I was. Whoops. Okay, so again, you know, so these I-bond rates will go up, but you do have these other options now because of the yields. Okay, so the next article I want to talk about is like where we've been, right? So again, S&P 500 hit its low point last year, October 12th, almost a year ago. It closed at 35.77. Sorry, that should be a comma. It closed at 35.77. When we look at what's happened in a year, the index is up over 12%. But we've talked about this before. Most of that performance is in 7 companies. So if you took out those 7 companies of the S&P 500, Microsoft, Apple, Amazon, NVIDIA, if you took those out, the S&P 500 would be down for the year. So this rally is sort of uneven because it's only in these few really big firms. And if we look at small caps are down about 5% from last year. So here we can see this. So if we looked at the sector performance since October 12th, these mega cap growth stocks like Amazon and Apple and so forth, this would be a fund. This is Vanguard's mega cap growth fund. Look at it, it's up 38%. If we look at the S&P 500 where we have equal weight, right? So each company has the same weight, that's only up 11%. And this is why we're saying that it's an uneven growth, and most of the growth is in a few of these really large companies. The average gain of an equity ETF is about 11%. So again, you can see this is about the same. And if we look at a small cap Russell 2000, that's only up about 5%. So again, you can see most of the growth in this past year has been from a few of these really big companies. Now, good side of this is, if we look back in history, in the year following an S&P 500 low, so we went from 2022 to 2023, the average gain is about 28.7%. We've only seen about 13% of that. And in the following year, which for us would be 23 to 24, it should gain an additional 12.5%. So again, the market's going down here in the short term, but in the long term, because of its performance, historically, it should be up. Okay. Again, now this assumes no recession. We've never had a historical case where we had this growth and then we had a recession. Okay. And this bull market is different from past ones, mainly because the Fed's been increasing rates. Usually when the Fed increases rates, the stock market goes down. It's starting to go down now, but they've been increasing rates a whole year. Okay. Again, now why do we think the market's going to go up in the future? Because if we look again historically, when rates peak, right, when rates reach the highest, and we're near that point now, we're near the highest and the lowest. So, you know, the Fed may increase rates one more time. You know, it doesn't look like they'll increase them more. They won't cut them as quickly, but still, we're near peak rates. Historically, when we're at our peak rate, the S&P increases by about 13% in the next 9 months, which is good. And then finally, as a positive indicator, right, every bull market has at least gotten back what we lost. So again, every bull market has at least gotten back what we lost. So far, this market has retraced only 83% of its loss, which means that it should go up at least 17% more. Okay, and this I see as the strongest one because the market's always recovered and always moved higher, always for 120 years. And so far, we've only retraced about 83% of the loss. So again, we may have this short-term loss, but if you look in the long term, you know, it's setting us up for the next couple of years, as long as we don't have a recession. And when we look at sort of this past year, we want to know sort of where's the money flowing to, right? So you can see equity ETFs have received $317 billion. So in this past year, $317 billion has flowed into stock ETFs. $203 billion has flowed into bond ETFs. So you can see even with increasing interest rates, more money is flowing into the stocks. But look at money markets, $1.1 trillion. That's, you know, 3 times more than flowing here, 5 times more than flowing here. So you can see the vast majority of money is flowing into money market funds, 1.1 trillion. And again, why? Because they're paying you over 5% risk-free. So understand the other reason, we've talked about this before, there's lots of money sitting on the sidelines, right? There's all this money in money market funds, and people are just waiting for when they think the market's on the way back up, and they're going to come rushing in. So again, we have lots of money on the sidelines. We have 1.1 trillion flowing into this cash, basically. And once people believe the market's is going up, they're going to start getting back into the market. Okay. Any questions on that? So again, that's our year performance. Okay, this talks about long-term investing, and we've talked about this. And again, this is one of our mantras, right? You want to leave your money in and just buy and hold. Okay. And what happens is when you have a lot of uncertainty, you have people who are pulling their money out. They say, oh, the market's going down, I'm pulling my money out. And then when the market's going back up, I'll put my money back in. Okay. And again, this is called market timing. And this happens a lot, right? I mean, even this market, right? we're looking at wars, we're looking at inflation, we have these increasing yield rates, we have political stalemates. I mean, there's a lot facing the market. So you can see why some people panic and pull their money out. But again, even when we face this wall of trouble, research shows you have to have some money in the market at all times. Okay, and I'm going to show you this in the chart. So over the past 20 years, if you had left money in the S&P 500 if you had left $10,000 in the S&P 500 for these 20 years, you would have had an annual average return of 9.8%. So your money would have grown from 10,000 to about 65,000. Okay, which is what this shows. If you had missed the 10 best market days in 20 years, again, this is the 10 best market days in 20 years. So you put your money in, you pulled it out, you put it in, you pulled it out, and you missed the 10 best market days in 20 years. You would have, your $10,000 investment would only be worth under 30,000, and now you would have reduced your return to 5.6% because you were trying the market timing. If you had missed the 20 best days in 20 years of trading, you would have only returned under 18,000, and you would have had less than a 3% annual return. Again, you can see if you had missed the 30 best market days in 20 years, you would only increase your 10,000 to 11,007, and you would have had less than a 1% return. You can see if you missed the 40, 50, or 60 best market days, again, in 20 years, we're not talking about 1 year, we're talking about 20 years, you can see that you would have had a negative return. So again, a lot of people say, oh, I always lose money in the stock market, because they do, because they put it in, they take it out, they put it in, they take it out. You cannot do that. Market timing is impossible. And you can see how much it costs you because you're trying to time the market. Most of the people who lose money in the market put it in, pull it out, put it in, pull it out. If you leave the money in, you can see you're going to do very, very well. So again, reason timing is difficult because it's hard to time the market in the short term. And again, a lot of times your best market days comes after your worst market days, right? So again, in the last 20 years, 7 of the 10 best market days came within 2 weeks of the 10 worst market days. And this is over a 20-year period. So again, it's impossible to time. If someone tells you they can time the market, do not believe them, because they cannot. No one's been able to time the market. Yet people put their money in and pull it out. And you can see if you do that, you're really reducing your return. And this is why a lot of people complain about the stock market. They don't make money because they put it in, pull it out. So again, even in these bad times, you want to leave some money there. Okay. Any questions on that? Okay, now for those of us who study charts, the charts aren't looking very good. Now we've talked about a death cross and golden cross, and we don't have time to talk about that right now, but we have the 200-day moving average. So this is the S&P 500 index. So the 200-day moving average looks at what is the average level of the S&P 500 index in the last 200 days, right? And that's what this chart is here. Again, this is sort of bad in the long term because you can see, right, we're coming downwards in the 200-day moving average, which means that the stock price is below the 200-day moving average, and we're just now starting to move back up. I'm sorry, this is the current price. This is the 200-day moving average here, sorry. You can see how smooth it is. Why? Because we're averaging over a 200 days. So the 200-day moving average is at 42.24. Again, I'm sorry, this is the closing price of the S&P 500. So you can see that the closing price is above the moving average. As long as it's above the moving average must be increasing, which it is. You can see that. Okay. This gold line, this is the 50-day moving average. So this looks at the stock performance of the last 50 days. So you can see in the last 50 days, the current price has been below the 50-day moving average, which means this average keeps moving down. And so the stock analysts don't really like it because we're above the 200-day moving average, but we're still below the 50-day moving average. And we were pulling close to it, but now we're getting further apart. So we have to get to 44.02. At this point in time, when the article was written, we were at 43.73, and now we're even lower, right? We're at 42.24, so we're basically at the 200-day moving average. So we closed at 42.24.16, and the 200-day moving average was 42.24.01. If the current price goes below the 200-day moving average, it will probably go lower. So again, we're right at this point of inflection, and we really want to watch it. Again, if the price goes above the 50-day moving average, then they will probably keep going higher. If it goes below the 200-day moving average, it's moving lower. And so we're way down here. We're real close to this point here. So again, we're at this important inflection point. Okay. And that's when we talk about reading the charts. This is what reading the charts means. You're looking at the current price versus these long-term averages. You're looking at these different support levels. Okay. So any questions on that? So again, we have to stay above the 200. And for the bull market to really take off, we have to get above this 44.02. Have to. Any questions on that? Okay. I still have a few minutes, so I want to go to our portfolios. So for those of you who are new, the second part of these is we look at different stock portfolios. And basically, one way we can break down stocks is we can call them value stocks or growth stocks. Growth stocks generally mean that the price expectations are based on future growth. So Apple has a very high stock price because we believe that the revenue of Apple will keep growing. NVIDIA has a high stock price because we believe the revenue of NVIDIA will keep growing. Value stocks are based on these appear undervalued for various reasons. So I don't want to get into that right now because I don't have time, but we do talk about it in our education class. So this is our value portfolio. So real estate is a value stock. So this is our real estate ETF. It finished at 75,442 a share. So for the year, it's dropped almost 8%. This is a healthcare ETF. Again, healthcare is generally considered a value companies. That finished at $60.12. That's off about 6% for the year. This is managed futures. This is not stocks. Why do we have this in our value portfolio? Diversification. So when the stock market goes down, this ETF is designed to go up. We want to see if it works. It closed at $32.90 a share. That's up almost 8% for the year. Again, why do we have it? Diversification. You can see it's working, right? All our value ETFs are down, but this one's up. So we've lowered our risk. This is our large cap value stocks chosen by artificial intelligence. This ETF finished at $30.48. That's off about 3% for the year. This is our Schwab large cap value index. That finished at 63.27 a share. That's off about 4% for the year. This is our small cap value. So these are small companies valued. This is finished at 154.28 a share. So that's off about 2 5/6. This is our financial ETF. Financials are considered value stocks. This finished at 32.61. So that's off about 4 1/3 for the year. So again, you can see the average ETF in our value portfolio is off about 3%. You can see the market's been deteriorating. On July 13th, look at only one ETF was negative for the year healthcare. Everything else was positive. And you can see since then that we've lost value in our value portfolio. This is our growth portfolio. These are all growth stocks. So ARC, which is a bellwether for the technology sector, finished at 36.47 a share. That's up over 17% for the year. This is our digital health ETF, finished at 15.89 a share. That's off about 14 2/3. This is our cybersecurity ETF, finished at 52.59 a share. That's up about 19 1/3. This is our smart factories ETF, robotics and so forth. That finished at 31.37 a share. That's up over 3%. This is our clean energy ETF. This finished at a 52-week low at $37 a share. It's off 20%. You would think clean energy would be doing well. It's off 20%. This is our Schwab Large Cap Growth Index, finished at 73.20 a share. That's up over 32%. And this is our cloud computing ETF, finished at 75.52 a share. That's up over 31%. So you can see growth stocks are doing much better than value stocks this year. This isn't always true, but it's true for this year. Although, again, if we look back on July 13th, we're doing much better. Our average return in our growth stocks is over 27%. And now you can see it's under 10%. This is the first time the average has dropped below 10% all year. Again, in even ARC, you can see ARC on July 13th was up almost 59% for the year. It was at 49.80. Now you can see it's at 36.47, and it's only up 17%. I mean, that's good, but it's way down from where it was up. So you can see even the growth stocks are, not doing that well. And you can see how the average has dropped from, 27% of July 13th, now down to under 10%. And it's the first time. So again, we're seeing this downward pressure, but growth is still outperforming value. So again, let's look at these. Large cap value would return you'd be losing 4%. Large cap growth, you'd be up 32%. Right? We see the difference between large cap and small cap value. Small cap value's been doing better. It's still lost, but it's lost less than large cap value. And this has been true all year too. So again, we're showing you the difference between a value portfolio and a growth portfolio. Last year, value outperformed growth. This year, growth is outperforming value. And then you want to look at sort of the differences in like market caps and so forth. Okay. Any questions on this, since I'm over my limit here?
Keith, I have a question. With the S&P 500, would it be beneficial to have the weighted S&P 500 and the equal weight 500? Is that like the managed futures?
Yeah, I mean, that's a good question. So if you think it's going to be a broad rally, then you would prefer the equal weight, right? So in the S&P 500, if there's 500 companies in there, they each have a weight of 0.2, right? Because, you know, when we multiply 0.2 times 500, we get 100%. So, so they each have a weight of 0.2, where you can see in the market value ETF, which we looked at, right?
Yeah.
Apple had a weighting of, you know, almost 7%. So, and you can see in that, you can see this year, because the rally is so narrow. Show you this here, right? We saw this where the S&P is up, what, about 16%, and the equal weight is only up 11%. So because the rally's narrow, when the rally's narrow, you would rather have the market weighted S&P 500, which most of them are.
Okay.
Now, if, you know, those mega stocks start going down and these other stocks start going up, then you would prefer an equal weight.
Okay.
Okay. Now, most of your index funds are market weight. They're not equal weight.
Right.
Okay.
All right.
Okay. So, you know, that's a trade-off you want to make. Again, generally, I don't generally have equal weight funds. I have all market weight index funds, but there's sometimes when, you know, the market weight could be a better choice.
All right. Thank you.
Yep. Any other questions? Okay. So what we want to watch for, we're in earnings season right now. Earnings have been better than expected, so that's good. Again, we want earnings to be better than expected, because the higher the earnings, the higher the value of the company, the higher the stock price. But we want to watch the Fed, and we want to watch the yields on the 10-year bond. So the 10-year bond is your bellwether bond. On Friday, the yields went above 5% for the first time, I believe, since 2007. And that just freaked the market out. So if the yields stay on the 10-year bond above 5%, the market's not going to be doing very well. If those start going down, then you'll see the market going up. So you want to look at the earnings, which are good so far. You want to look at the yield on the 10-year, and you want that below 5% if you want the market to do well. And then you want to watch the Fed meeting in November. So in November, the Fed's going to meet, and they're going to decide, should we increase rates or leave them as they are? They won't decrease rates for sure, because inflation is still too high. If they increase rates in November, the market will go down somewhat. If they don't increase rates in November, you'll see the market jump up, because that's signaling that we're at the end of this rate hiking cycle. So again, those are the 3 things we want to watch. Earnings, which are coming out every day. So far, they've been good. The yield on the 10-year, which has to come down below 5%. And we want to watch what will the Fed do at their next meeting, which is coming up in about 3 weeks. All right. Okay. Any other questions? I'm past my time. I know we're all busy on Saturdays, so. Okay. Okay. If not, we'll see you on our next meeting, which I believe is on the 11th.
Our next meeting is on the 11th.
On the 11th. And if you have any questions, feel free to make an appointment or email us. We're always here to help you, so let us know. Okay. All right. Thank you, and we'll see you in 2 weeks. Everyone be safe.
Remember to share with your friends and family. Those of you who have emails with us and are registered, that you get your invite. Make sure that you give the name and email address of anybody that you'd like to join or who wants to be part of this learning community. Then you would send that to either to the email, to whoever is sending you the email, because some of them come through the Sean Carter Foundation and some are coming through Bridges to Wealth. So whomever you're receiving your emails from, that is the person that you should be contacting to inform them whether you receive your registration, or if you have a new person, their name and their email address should be forwarded to your to either the Sean Carter Foundation or to Bridges Wealth. In the
Yeah.
meantime, thank you for being here. Thank you, Professor Keith, for your expertise and sharing it with us. And we will see everybody on November the 11th. Have a great weekend and stay safe.
Thank
Thank
you.
you.
Yeah.
Yeah.
Thank you.
Bye now.